The war in Iran has been going on for a few weeks now, which has interrupted the supply of oil from the Middle East. How does this affect the economy and markets, though? I'll show how an oil shock like this can impact interest rates, the stock market, and the overall U.S. economy. First, we'll take a look at the yield curve. Interest rates for Treasury bonds have increased, meaning investors are demanding a higher interest rate to lend people money. Just in the last week, the 10-year note has increased around 14 basis points in yield. But what is driving rates higher? Rates on longer dated bonds like the 10-year are affected by a few things, but in this case, because of the oil shock, the primary driver has been expected inflation. Towards the beginning of the year, expected inflation was a little under 3%, but since the war in Iran started, that rate has increased. This means investors are expecting higher costs in categories like food, shipping, and fuel. If you think about it, this makes a lot of sense. The price of crude oil is up over 70% year to date. Crude oil is used for all sorts of things like fuel, shipping, manufacturing, and chemicals. When this critical input price goes up, the price of everything tends to increase. You can definitely see this through the increased price of gas. What has this done to expectations of growth? The Atlanta Fed 2026 GDP forecast has decreased 0.5% in just 1 week. If GDP slows too much, or if GDP growth turns negative, you might see more unemployment, stagnant incomes, and lower consumer confidence, causing people to spend less. All of this can start with oil prices, and when they go up, so does inflation, while growth tends to slow down. Stagnant economic growth and rising prices is definitely not good for the U.S. economy. All of this also impacts mortgage rates and housing. As interest rates go up, the rates banks charge for mortgages goes up too. The 30-year mortgage rate has jumped over 20 basis points in under a month, meaning people have to pay more for that same house. Unaffordable housing can pressure prices to go down, which can affect the entire housing sector, which is a large chunk of the U.S. economy. Stocks have also been getting hit, with the S&P 500 down over 5% year to date. Higher oil feeds through to companies since they have to pay more for inputs like shipping and raw materials. This affects their profits. Since profit margins are negatively impacted and robust growth in the economy seems less likely, stocks may not be as attractive to investors. The Iran war is mainly an oil shock to start, but this reverberates through bonds, stocks, and housing. Consumers are also feeling the squeeze. And while the shock has spread fast through markets, it's still early and there's no guarantee of exactly how this might play out. Oil shocks like this, though, have never been good for the economy, and historically we've seen the same general framework of higher yields, lower stock prices, and lower confidence that the economy will grow.